Good afternoon, everybody. Uneducated economist here. So let's talk about the bond market for a little bit. I said it a long time ago that you have to keep an eye on the bond market. Once you start seeing the bond market roll over, you're going to start seeing some serious issues with corporations trying to fund themselves. You're going to start seeing defaults taking place. And right now, I feel that the debt market is probably going to be the biggest issue going into the future. It's not going to be the shortages are going to come up, like we were talking about it briefly in the last video. We're going to see some serious shortages come up here. I couldn't tell you when, but it's going to be after this surge of inventory that is hitting the supply chains right now. Once that works its way through, there's going to be very little manufacturing taking place right now that's going to replenish that, and that's going to be a dangerous situation all on its own. But leading up into that is going to be the rising of interest rates. And the rolling over of old debt into new debt is going to become very difficult. So if you cannot roll your old debt into new debt, or the payments on your old debt rolling it into new debt becomes more burdensome on you, whether you're a corporation or an individual or whatever, that means you either have to earn more money or you have to cut back on your spending. With the rising of inflation and the prices of everything, cutting back on spending means that there is going to be less economic activity taking place out there. Once less economic activity begins to take place, then you're going to start seeing issues with growth. People are going to have a hard time doing business because there's less people spending money. This is the slowing down of money velocity. Now, whether that takes place or not, on account of what the Federal Reserve ends up doing, like what they end up doing, I don't know if I'm speaking right here, but as the forward guidance is telling us, is that they are going to raise interest rates. They are trying to put a slowdown on demand. They are trying to tell people we want you to spend less money. That is less economic activity. That means less jobs. That means less business opportunity. Think about what they're saying here. Like, everybody's like pointing at prices, saying they're trying to control prices. They're trying to control economic activity. The prices came from a supply chain breakdown. That's what caused the prices to go up. Now, granted, the money printing, go burr, and all the other stuff, and the printing, the stimulus and all that. Yes, that is true. That did flood the market with a lot of dollars. And given that there was a limited amount of supply out there, then yes, supply and demand, you're going to see the prices go up. However, whether it's the government taking out the money and giving it to the people, or the people taking it out on a credit card, the money has to be paid back. So what's going to end up happening is that as we go into the future, people are going to have to postpone their current spending in order to pay for the past consumption. Think about that for a little bit. This is what the Federal Reserve is trying to do. They're trying to postpone current spending. So when these corporations go to try and roll over the debt, this is going to be the biggest issue. Because when they go to roll that debt over, they're going to find that they're going up against competition. What's the competition? The safe haven asset of the U.S. Treasuries. Guaranteed to pay. Zero chance of default. Now, everything else out there is a risk after the U.S. Treasury. And if you go and look at some of the articles that I put down in the description, you're going to find like the Chinese debt is becoming very close. In fact, it's lost its premium. Why would you loan the Chinese government money when you can loan the United States money? People ask, where is it that the Federal Reserve, after the Federal Reserve starts to unwind their balance sheet, when they get rid of these U.S. Treasuries, when they unload them, sell them, let them just mature, who's going to be buying these Treasuries? This is the question. If nobody's there to buy them, like the Federal Reserve, who has a printing press, then the prices of them are going to fall and the yields are going to rise. The government won't be able to afford these debts. But if the yields begin to rise to a point that it's now matching everything else out there, all the risk, then people aren't going to take the risk. They're going to move to the U.S. Treasuries. Eventually, this is going to find an equilibrium where people are just, the investors are going to say, I'm not putting my money towards corporations, putting it towards China, Russia, or whatever, I mean, I don't know why you would loan to Russia right now. But if you did, I mean, their debt is probably incredibly cheap right now, so you could probably pick up Russian bonds very, very cheap if you could find somebody who could sell them to you. I don't even know if Americans can even, like, or, an individual could even acquire U.S. or Russian bonds. But if you were to, they would probably be very, very, very inexpensive. I can only assume, because nobody's going to want them. They're pretty much going to default, meaning that they're not going to pay. So this is where the U.S. Treasury is going to find their support, is throughout the world debt markets. Everybody else out there is going to be at very high risk, and if the yields begin to rise on these U.S. Treasuries, people are going to move towards it. Eventually, it'll find that spot. Now, I'm most worried about Contagion. This is really where I think a lot of people are like, who cares about what happens to some corporation in China? What difference does that make? The difference is that a lot of this debt is leveraged off of everybody else. So everybody's carrying somebody else's debt. And I've explained this in like Evergrande, right? The biggest property developer in China. They had what was called commercial paper, or what is commercial paper, along with bonds and everything else. But commercial paper is a short-term bond, sort of like a bond. Ultimately, if you get paid, Evergrande will sometimes pay these contractors, the people who they are hiring to assemble a building, they'll pay them in commercial paper. So let's assume that the commercial paper has a face value of $100. Well, the contractor will receive it for like $97. And if they hold on to it for, let's say, a year, it'll mature to $100. So they gain a little bit of interest just simply by holding onto this commercial paper for a short period of time. Well, if Evergrande goes into default where they can't pay this commercial paper, when it comes due, it's just like, hey, it's $100 face value, but we're going to only be able to pay you, say, $60 or even less, say $20 on it. It's only 20 cents on the dollar that we're going to pay on this commercial paper. That's essentially a default. Well, if you hold this commercial paper on your balance sheet, you got assets and liabilities. This commercial paper is part of your assets. So if you have a balance of assets and liabilities and all of a sudden your assets begin to fall because this commercial paper doesn't pay 100 cents on the dollar, it only pays 20 cents on the dollar, well, pretty soon your credit rating is starting to go down. Which means that all your debts out there have a lesser credit rating, meaning that rolling your debts over into new debts is the same problem. You're paying a higher interest rate on it. So the credit rating on all these corporations who are holding the commercial paper from Evergrande starts to diminish. And then so on down the line it goes. But it's not just these corporations who fail. You got to think, it's like everybody who is invested within these corporations, within these nations. And you have to think like pension funds, insurance companies, stuff like that. And a lot of these individuals or entities are limited on the credit rating in which that they can buy. So they may not be able to get into some of this junk debt because of that credit rating isn't substantial enough. Excuse me, guys. Meaning that they have to have a credit rating of like, AAA or, a B rating or higher, or triple B rating or higher. They have to have an investment grade rating. And a lot of these corporations just simply don't have it. But they can get around that because you have these, what they refer to as collateralized loan obligations or collateralized debt obligations. These are where loans for risky businesses take place. Because these loans, they go and get packaged up with a bunch of other loans. And then they get diced up and cut into what they call tranches. And so as these businesses start to pay back these loans, the people at the top of the list, at the highest tranche, they get paid first. And then the rest of them down the line get paid as the risk goes up. The reward gets higher. So they get more interest as it goes down the line, but the risk goes up. The people at the very top, they're almost guaranteed to get paid first because you have all these businesses paying back their loan. Now, these are risky businesses going into this collateralized loan obligation. But with all of them working together, the top tier, the top tranche is most likely going to get paid. They give that a AAA rating or an investment grade rating. It may not be AAA, but it's an investment grade. All the stuff that went into it is crap. But because there's so many of them and the likelihood of it defaulting at the very top is very low, they're allowed to invest into these corporations or these businesses. This is like the pension funds, the insurance companies. Think about that for a bit. This is one of the reasons why you have to keep such a keen eye on the bond market. It is going to be very telling of what's going to happen into the future, and it can have a very substantial contagion effect as it starts bleeding into other corporations, other nations. So, anyway, I got to go back to work. Uneducated economist, you guys let me know.